Hello, Smart Money podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Jade Miller. How are you doing today, Jade?
Hey Kirk, I'm doing great. Thanks for having me on.
Great. Well, glad to have you. For those of you who don't know, Jade, maybe you could tell us a bit about your background.
Yeah, so I recently took over as the first ever CEO of ADISA, the Alternative Direct Investment Securities Association, last summer. I previously sat on the board of ADISA for the past 5 years, but before that, spent most of my career in alternative investments. So I spent the last 15 years in the private markets, primarily real estate investing. I think when I think alternatives, that was the foundation that made the most sense to me as a 22-year-old leaving college, but I've grown to explore the entire alternative market and kind of in my career spent time wielding and seeing where alternatives should go, how what they should look like, and trying to get access to the general public. So that has been the foundation of my career over the last 15 years. And so taking over ADISA is naturally in line with growing, the alternative investment space.
Nice. So what is ADISA for those who don't know it?
Yeah. So again, acronym very close to Adidas, not Adidas, Alternative Direct Investment Securities Association. We are the largest trade association for think private alternative investment markets. So we spend a lot of time advocating for alternatives for financial advisors, for fund managers. We spend a lot of time educating. So we put a big emphasis on education and due diligence on private investments. And then we host networking events. So we do a lot of networking in line with education. Think, pairing up allocators and providers so that we can get broader access to alternative investments in the marketplace.
Cool. Yeah. So I know our firm's been in alternatives for quite some time, and the industry has evolved quite a bit in the last 15, 20 years. Um, where do you see what do you see as the biggest challenges in the alternative asset space?
So we're in an interesting shift right now. The biggest challenge up until the last 9 months was accessing alternatives, right? Alternatives were always seen as something that only like the 1% can have. Like they were this foreign, like we don't understand it. We don't know how to get access to it. Where are alternatives? And lately, there's been expansion in through Congress on putting alternatives in 401k plans or retirement plans. So I think there's this wave of, okay, now everyone can access alternatives, but now the challenge is what is actually an alternative? And are we using a broad lens on alternatives? When I think alternatives, I think non-correlated, right? That is the premise behind where alternatives started. Not a stock, not a bond, not going to be, more of a hard asset or a tangible asset. And so I think when we're looking at some of the access that we're getting to mass markets going forward with new legislation, it's going to be a little bit less of an alternative, more a little bit liquid, which is typically not what you would see in an alternative asset. So I think the challenge is still just going to be educating through this shift of, okay, yeah, you're touching the surface with alternatives, but there's still better options out there. You need to dig deeper. You need to go to the next step. You need to be aware of what an alternative can do for your portfolio outside of some of these larger scale alternative investment funds.
Yeah, it's interesting. When we get started, we were primarily in the individual alternative asset space. People considered alternatives like hedge funds, and that was, I think, back in '99. That was like the first, quote unquote alt that was out there.
Yeah.
Um, I think it was 2008. They started. This is kind of like Wall Street when I say they. They started to consider alternatives, alternative strategies. So they were still investing in stocks and bonds, but it was an alternative strategies because people wanted alts, but it wasn't really an alt. It was just it was a nice shiny wrapper, an alt wrapper they put on it, but it was really the same thing. And since they've evolved the industry quite a bit, um, it's interesting. You mentioned 401k plans. What are your thoughts on alts going into 401ks?
So I can argue both ways. The part of me that says like PR alternatives, like let everyone know like what they are, says like great, right? Because now someone who would have maybe never had a financial advisor or for years will now hear what they are, right? They can sit in a Fortune 500 company 401k plan and have a meeting, right, where the benefits consultant comes in and says, okay, here's an option. So at least they're getting exposure. The other part of me says, like, the part of me who, to your point, is like, goes back to traditional alts. Like for me, traditional alts was like real estate, or like the old phrase used to be like country club investments, stuff that you didn't think, you're always like wondering who owns it but didn't have access to. Says like, I don't want people to think like, okay, these big, again, semi-liquid funds in my 401k, that's an alt, or have a bad experience or something, and be like, well, these are, mid-size returns versus what alternatives can be, which can be very lucrative returns, right? But to have those lucrative returns come more risk and all of that. So I think there's, part of me that says, great, we're getting exposure, we're educating. But the other part says like, ugh, it's just touching the surface. Like, I don't want people to think like, hey, check the box. Like, I want to be able to make sure that people go deeper on like, what is the next level of alts after that.
Yeah, I have, I guess I've been around enough to be a skeptic, even though I'm, very much in favor of alts, what have you, especially in retirement accounts. I think the direction's great. I think the challenge is the reason they're pushing for alts in 401ks, specifically private equity, is because they don't have enough capital to get into private equity. So they're trying to seek out additional capital, which inevitably is going to burn a lot of investors who, if they can't dump their private equity shares on the public, then they can't then it's not really worth anything. And I see that as the reason why they're trying to get into 401k plans, which I think is very dangerous. And unfortunately, I think that will scar a lot of investors from alts because of this trend. And they might even institute regulation down the road because, oh, a lot of people got burned by this. I think it's unfortunately there's a lot of political money pushing this, but I think it's very potentially very dangerous. Even though it's a great thing at this, in the same time, I'm just like, oh, I see where this is going. It's not good.
Yeah, and to your point, we're talking like, it's not going to be when I think traditional ADISA like money managers, right? Traditional ADISA members, or what I consider in our alternative space, some manage 100 billion, but their funds are all smaller. We're talking about like the Goldmans, the JP Morgans of the world, and the funds that they're managing, right? And having access to capital. And so to your point, I do think like it's one of those things where they're not getting the true hands-on small fund manager who runs 10 apartments like type alternative. And so it could leave that bad taste, or like, that's my point on like, you're getting the idea of it, but it's not the deeper education. And so it's going to be lumped together as, oh, well, my 401k was an alternatives and it did fine, or it did mid, so I don't need to learn anymore. And so that's where I'm like, ooh, good that we're learning the word, but bad, like we're going to need to overcome some of the challenges it'll face being with larger money managers, or in a, the way they're going to have to structure this to be in a 401k plan and offer liquidity and all of those things.
Yeah, I mean, how do you how do you see that working within 401ks? I mean, the liquidity part's obviously an issue, and um, I certainly see if it's like a solo K plan, it's just like me and one other person. But if you've got like a 1,000, 10,000 person 401k plan, it really kind of muddies the water. So how do you see that process going?
So I can't speak to how they're going to structure the plans. Like, that the way the benefit, once you kind of tie into with benefit partners and all of that, I do think in one of the trends that we're seeing in general in alternative fund space, that it's going to be a lot of 40 act or tender offer interval funds, right? Which that has been a trend in general because there's been this cry for liquidity. So that is going to be the type of fund structure that has to go in it, I think. Which again, yeah, I think the popularity among those fund structures is allowing for different types of investors or first time alternative investors, because illiquidity is a concern, right? So I think it will help. I think what you're going to see is that they will have to be very careful about how these funds structure share redemptions, because whoever is managing the plan, right, will come in as a whole. And so it'll just be large entities. And I would be curious. I know it's way too early in the regulation and where we're seeing on how they would like limit allocation, right? I think there is going to have to be allocation limits set as they look to structure those plans. And I think it's too early to say what they're going to do. I just think what you're going to see is it's going to be an overwhelming option of interval and tender offer funds.
Yeah. What I know one of the challenges of illiquid alts is, going into retirement accounts is, um, I've seen over the years there tends to be a lot of, not a lot of, but there tends to be a higher propensity for fraud or fraudulent investments or questionable investments, because tapping into retirement accounts is pretty much dead money. You're not going to touch it for 20 or 30 years. And it's this pool of money that just sits there, and people tend to do a lot less diligence on it. And so what have you seen? I know ADISA does a great job of making sure that a lot of people are qualified, but in general, like, how do you see that aspect of it? Just in your experience.
So I think it's going to be a regulation challenge because again, I think like when we're saying retirement specifically, if we're talking about the 401k plans, to your point, where is the asset manager going to have some flexibility if they know there's no redemptions coming from, say, 50% of the allocators because they're retirement, or 50% of the money coming in because it's a retirement plan, then they might be more flexible on redemption requests from the other 50%. And so I think how they offer liquidity and redemption requests and allocation policy for the investment manager are going to be crucial. I think the SEC is going to have to be all over that, as they look into this. I do think like there's other ways to get alts into retirement plans. We have a lot of people who do like Roths or IRA money, right? Like that's a huge one. I think those require more due diligence. Those are where you really need a financial professional to guide you. I know for us, we've put a huge focus on due diligence for our entire existence, but more so in the last 5 to 10 years, just ramping up transparency. I think that is a huge shift that we are seeing from the investing public now, or like the investing population, along with like the technology, the way everyone can access information. So I think the transparency from these managers, whether it's in the 401k plans, whether it's in the smaller funds and the Roths, is going to only increase. And I think that's going to be a more of a shift, not from the investor. Like the investor is going to demand it and wonder why they can't get it. I think the asset managers and the fund managers are going to have to get used to just being more of an open book versus trust me, I got this. Here's your report, here's your returns. And so I think that'll be a good shift for retirement accounts in general, just kind of a shift of obligations and letting go of this old, like, well, I don't have to report, but people want to see more reporting. They want to see more transparency to be able to make sure there aren't any misdealings.
Okay, nice. So when you mentioned due diligence, what are some best practices people should be thinking about when it comes to due diligence for alts? Because it's obviously a little bit different than just, buying a stock or a bond on the stock market. Um, and most people don't have a kind of background or understanding to get into this space. So what would you recommend in the area of due diligence for people thinking of investing in alts?
Yeah. So first, I'm going to say I would almost always recommend going with a financial advisor. I think having someone whose job it is, right? A financial advisor has their insurance. It is their profession on the line. It's the same as like having a real estate agent look over, the title before you close, right? Making sure like setting up all the documents. Your financial advisor, they are paid to do that. Furthermore, they have like a helmet, or I say a hub over them who also is paid and has, their business on the line to make sure that there is due diligence done. But in general, I would say a lot of people don't read the PPM. I get it. I think understanding what you're investing in and making sure the numbers line up. If it sounds too good to be true, typically it is, right? Like I hear it and I think like crowdfunding, unfortunately, is probably the biggest offender of this. People see crowdfunding and they're like, oh, 24% returns, but everything else says 12. Let me take the risk on the 24. Like it's pretty obvious right there, guys. Like if something is standing out as doing significantly better than its peers, I would try and figure out every number, right? Go through it, do all of these things. I typically would say crowdfunding is probably your riskiest access to alternatives. There's very little vetting and standards. If you're going through something or a fund that is raising money from multiple sources, like I would ask that, where else are they getting capital? If it's just coming from, again, I hate to say keep picking on crowdfunding, but if it's just coming from crowdfunding, they've never had to go through a vetting process, right? As long as they file legal documents, they can say whatever they want. So I would kind of check where they're raising money from, what are they setting their standards at, what is their accountability. Like that is the first thing I would look for is, how is the return subordinated and what is their skin in the game? Because if somebody is not willing to put their skin in the game, like huge red flag. Pretty easy these days to do a Google search. That one always shocks me, right? Like it's pretty easy just to run a company's name through Google and see if they have any pending lawsuits, any liens, right? Not perfect, but I know there's always Chat GPT that can. I did it for a car recently. Give me the pro cons of these models. Like Chat GPT can be a good starting point depending on what you're looking for. But in general, I typically say having a financial advisor, it's not usually it's their structures are aligned, right? You're not typically paying for the financial advisor. Typically, the fund or who you're investing with is paying for the financial advisor. So for the most part, it comes at no cost to you, but it's going to be someone whose job it is to look and make sure everything is in line and kind of be like an insurance in case. But I think reading your investor reports, requiring investor reports, making sure you're getting up to speed on who they are, what they're doing, and that the numbers don't look too ostentatious. I think it never ceases to amaze me how many people are like, but they said it was 28%. And I'm like, all of their peers were 18. Come on, guys, So I think common sense sometimes should be like gut check always.
Okay. What's your favorite asset class?
I'm biased. I grew up in real estate, so I started in real estate, and I think I started in the alternative investment space while I was in college. I was working for a financial advisor, and candidly, I had none of it was clicking, right? Like none of the stocks, bonds, we were doing mutual funds. I'm like, this is so boring. And someone came in presenting real estate, and to me, that was the first investment I understood. It's very simple, right? Okay, you drive past this building. Someone is paying rent to, be the business in this building. Someone is making money off of that. Like, so to me, that was easiest to understand as it related to alternative investment space. But in general, I think real estate is fun because it is tangible. It is something you can see. I do think they're in the specific asset classes or right asset classes. There's going to be longevity, right? There will always be a need for apartments, for instance. There will in some case be a need for office or warehouses, right? Like if you look at Amazon, right? Amazon will always need warehouses. So at some point, real estate will always have a profitability. I think what I like about real estate, and you can do this with other asset classes, but real estate and mostly oil and gas, there's a lot of tax benefits that might not meet the eye. There's going to be real estate depreciation, but otherwise, there's a lot of structures that you can do with real estate that can be an economic benefit to like the area around you. Like if you look at opportunity zones, right, that can be used to help benefit different communities. So if people are looking for like impact investing with tax investing, I think real estate can be the play for that, as well as, again, just different tax advantage opportunities as people are looking to maybe get income, but also mitigate risk. I think there's a lot you can do in that space.
Nice. So you mentioned tax. What are some ways that alts can benefit people on the tax side? I know that's kind of a big push in the last few years. Everybody's looking for better tax treatment. So what are some ways that alts can help in that way?
Yeah, so I would say when you're thinking private market alts or specifically the ADISA members, tax benefits are probably our biggest like bright flashing light selling point. Look at me. I think what we've seen are the structures. I mentioned opportunity zones earlier. That's a huge one. I know it's an interesting year, but there's more coming in with Big Beautiful Bill as far as investing in different real estate, different oil and gas opportunities that are going to give you, again, an economic benefit from areas you're investing in, lower income areas. You're also going to get a good income stream, but you're going to get a write-off. And then the one I think is not talked about enough is a Roth conversion strategy. I think that's a huge benefit as you're looking like as an investor, as a financial advisor to advising as people are aging, like where you can get a decent, flip on write off and grow your income while reducing tax liability. Oil and gas is a huge tax liability space. That's only continued, I say tax liability, tax mitigation space. That's only continued to grow over the last 3 to 4 years as far as ways that they can utilize that. I think people hear oil and gas at first and they might be like, no, bad for the environment. But I think once you understand the strategies, you're realizing that's not what they're doing. Some are participating in like natural gas, natural resources, and they're still being able to give like an immediate write off. For me, when I think like, where does this fall on the risk spectrum? A lot of these still have liquidity, like, or I say liquidity pathways, as well as offering income. So you're getting an income stream, but right away you're going to get that tax benefit in that first couple of years. So to me, I'm like, there, either way, you've got some benefit. So you can sleep at night knowing there's some benefit as you see growth. And to me, that's kind of like I say a gateway drug into alternatives of understanding how these deals work. The most popular one that we've seen the last few years, and I would say that's more of a household name for middle investors, is going to be your DST 1031 space. I think what you're seeing is you're seeing a lot of people who have either sold a property or have heard of this DST 1031, whether it's from a financial advisor or an accountant. And that's a good way to start understanding private markets. And I think to get in front of someone who can educate you, again, a financial advisor, a seminar, who can say like, hey, this is step one to mitigating, real estate returns. And now I'm going to, open up your world to a number of options.
Nice. Yeah. I mean, Roth conversions I always find is interesting. I think people, what I've seen, people try to overdo it. They say, oh, I should convert to a Roth because they hear it on TV and everyone's talking about it. And it's like, why? Why do you want to? You're in the you, you're in the 39% tax bracket. Why are you trying to convert to a Roth? It doesn't make any sense.
Yeah,
Um,
that's where like I think the understanding of real estate, right? Like if you're in a development, that's how that works, right? You're valuing it, what is the development worth? And then you're flipping at a lower basis and then letting it grow. But yes, just flip without lowering your basis first. Probably not not the smartest strategy to your point, just because TV says so.
Yeah, well, I think what's interesting is I think most people haven't done the math. Um, what I find interesting is years ago I did the math because somebody asked me, and I was like, all right, well, let's just run the numbers and see. And I was shocked. Some of like the smartest hedge fund managers don't even know this. Like it's just no one's bothered to stop. They just think, oh, Roths are better. It's like, well, if you look at a traditional Roth, like all else being equal, the results are the same. If the only thing that, and you can't predict performance, the only thing you can predict is tax rates going in and tax rates going out. Um, and what I'm surprised at is that, people at a high tax bracket are like, well, I need a Roth. I'm like, why? Like, just you're trying to reduce your tax, when you're in a high bracket and you take it out when it's in a low rate. But Roth, it's like you're paying your taxes now, and you're not saving anything. It's six of one, half dozen the other if you're doing a Roth in a high tax bracket, but that's what everybody wants. So I always find it puzzling that people haven't done the math, but I think the government did a poor job of explaining that it's literally the same, all else being equal. But
Yeah, it has to be paired with the right strategy, right? Like again, like you have to like to me, it doesn't make sense to flip 100,000 to 100,000, right? To your point, you're just paying taxes now. That's where some of the strategies in the alternative space, right, can take it from 100,000 to say 60,000, right? Because you're valuing it. What is it worth when the concrete is poured? So then it's 60, and then your investment grows back up while you're getting income. So yes, to pay taxes on 60,000 right now and letting it grow back up to, in a perfect world, say 120, that makes sense. But to flip it 100 to 100, no.
yeah.
Again, unless you just think the tax brackets are going to be drastically different, but then you're betting on tax brackets in the future versus actuality.
Let me ask you this because I know with individual alts you can do that. You could do the revaluation at certain points. But how does that work in like funds? Because I think a lot of the alts are in funds of sorts, and is there a typical time that these investment sponsors set it up so people can do that, or how does that work?
Yeah, so this is like I love talking about like a fund structure. That's my favorite thing on alternatives. So that is something I would say most of the ADISA members, specifically real, you cannot do it in credit, obviously. Well, I wouldn't recommend it in credit, but for oil and gas or energy funds and then real estate funds specifically. So for instance, let's say you and I, or if I had a fund, you could do it with a couple of properties or one property in a fund is typically the easiest, but you can do it with a couple properties as long as the timing is generally the same. So if I go out and raise, say, $100 million and I'm going to invest in, let's say, two real estate deals, you would invest at $100 million, say $5,000 per share. You're going to stay in for a year. I'm going to raise the money. We'll, start clearing the site, all of that. And then year two, so we've been in for a year. Now we're clearing the site. You've gotten one full year of tax return. Year two, I'm going to go have typically one, sometimes two auditors come out and they're going to give you a valuation. How much cash is sitting at the fund level? How much is the property worth? And if it were to sell today, on average, it can be anywhere from 20 to 40%, just depending on the property. So then I'm going to go back in and say, okay, your shares today, if I had to value them today, instead of it being, $5,000 a share, 100,000, these two properties are only worth 65 or, 65 cents on the dollar. So now I'm going to value your 100,000 at 65,000. In that tax year, you are then going to convert. You're going to go to your custodian and say, flip my IRA to my Roth. That tax year, you're going to pay 65,000 on the Roth. Like, right, you're going to pay taxes on that 65. And then over time, as it continues to build, it's going to start to value up and up and up. And depending on, the structure of the fund, you would possibly be getting income along the way. So that is typically how it works, but you should value in year two. Year two is almost always going to be your lowest. Year one is pretty early to value. You typically some people can, but you typically want to have a year of tax returns, but year two would be your value and then it would slowly go up. Some people, you could still wait until year three to flip, but you always want to flip at the lowest point. So just as from a fund versus a fund and an individual property work the same. But again, with you could do it with value add. It doesn't make sense to do it with a stabilized property. So you almost always want to do it with something that has a growth upside or a development. If you and I go buy a property that doesn't need any tenant improvement, the value is probably going to be roughly what we bought it at. So that one wouldn't value lower. You would want it to be something that is, again, going to depreciate in value only to appreciate through the life of the fund.
Yeah, that makes sense. So you want to do it when there's a hole in the ground, not when it's fully developed.
Right.
What about if the property's, all set, but it's not rented out, right? Because it's commercial space, it's not rented out, it's not worth very much. Whereas rented out it is.
Yep. So they can still do it on that. So again, that's where you would have your third party would come in. They would say how much money has been invested in this building and then how much cash is coming out. So they are looking at the cash balance versus that. And so they could say it might not be worth what you paid for it day one. So as long as what the cash flow is coming from, say, an empty building isn't worth what the capital raise was, or there's been cash put into it, probably for the acquisition, the cost of the bank, right? You can get some depreciation. I would say on something like that, this is just me estimating, you're probably looking at somewhere between a 10, I would even say 5 to 20% depreciation versus a development. So it's going to be a little bit lower, but it still could save you that 10%, right? If you want to flip or, depending on the balance size. So that's where it can be some, but anything that's going to require more work to either lease up, develop, or build is going to be where you're really going to get that depreciation benefit for the flip.
Yeah. Okay. That makes sense. Um, all right. Well, as we kind of wrap it up here, what are some final thoughts you can leave us with about alts that we haven't kind of discussed that you think are important?
Yeah, I think depending on, where you're at, whether you're a financial professional or an investor, if you're not educating yourselves on the alternative space, you are going to be left behind as you look to build and allocate your portfolio. For financial advisors, if you're not talking to your clients about alternatives, they're going to find someone else. Right at this point, every financial advisor, whether it be wirehouse, RIA, has access to an alternative portfolio. So you need to be educating yourself to compete with other financial advisors. And then as an investor, if you're looking to take it to that next step, if you're looking to get, some, I say, shelter from the stock market, you definitely need to be talking to someone, looking to someone about alternatives. I would say in general, the more risk you're willing to take with liquidity, the less liquid, the better returns you're going to get. That's the more alternative traditional model. So I would start there as you're kind of starting this journey if your risk spectrum allows for it. I would just continue to urge everyone to require due diligence, require transparency. In a time with technology the way it is, if someone's not willing to answer your questions on an investment, probably not a good sign. So just keep the standards high. I think that's going to be what's best for everyone as a society, is holding people accountable so that the investment managers have to get better, have to do better, and the investments themselves will be better.
Okay, awesome. Well, Jade, I really appreciate you coming to the show, sharing your wisdom with us. Where can people find more about you?
Yeah, so if you go to ADISA, ADISA.org, that is our website. You can see all of our events. We have an event coming up here March 30th, but we do have ongoing education on the portal or on the website, as well as, on our YouTube channel. If you're looking to learn more about alts, I would recommend checking it out or attending one of our upcoming events.
Awesome. Well, I appreciate you sharing with us, Jade, and we'll have you back on the future.
Thanks, Kirk. Have a good one.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right, that was a great interview with Jade. Appreciate her coming on the show. Now we're on to the panel portion of the show where we have our very own Barb Freeberg. Hey, Barb.
Hi, Kirk. Hi, Mark. Happy to be here.
Yeah, glad to have you on this week. We also have our very own Mark Walton. Hey, Mark.
Hi, both of you, Kirk, Barb. Pleased to be back again. Thank you very much.
Yeah, glad to have you both. So Barb, what were some of your takeaways from the interview?
I like alts. I like the concept of them. And in particular, I love real estate. Real estate is where I actually got my teeth wet. And I just think there's a lot to talk about. But unlike investing in private markets, stocks, bonds, which you can trade on a dime, have your money within 3 days, and everything is required by law, all the details to be very transparent. Alts require a little more due diligence on the investor's part.
Yeah, I would agree with that. I think that's good sentiment. Mark, I mean, we obviously talked about alts in the interview. What are your thoughts about alts in general?
I'm heavily into alts. Because of the trading background, I last year was heavily, well, I've just got up my notes up on here. I'm 20% into mining stocks. And so we spoke about this in December, and gold was up 80% last year. Silver was up 160, I think. And then some of the mining stocks were up 300%. And I have bought mining stocks on the recent dip from a couple of weeks ago that are up 40%. So it's a trading background, but I am more into that than the mainstream stuff. So I do have some Amazon and the Meta and the things. But in fact, I actually sold a bit of Amazon yesterday because even though I only buy something if it can make at least 25% profit in a relatively short space of time. But for me, the alts are where the real profit is. And I also hold physical gold and silver as well, because at the end of the day, I did a podcast on the 6th of January saying the world to me is in one of the most dangerous stages I've known in my lifetime, probably since the 60s when I was a kid. And I mentioned Venezuela in that in the Middle East, and look what's happened in the last few weeks. So for me, I am heavily into alts and miners, uranium, rare earths, and even some cannabis stocks still. So yeah,
Nice.
I'm into it.
Yeah, I mean, for those of you listening, this is we're recording this on March 4th, which is a few days into the Iran war. So
Yeah.
things have changed quite a bit. But so Barb, I mean, you're a traditional gal, but how do you, I mean, there's a lot of different versions of alts. How do you look at alts? Do you use them? Do you think they're a good idea for people? Like, what's your view on this?
I could talk a long time on this because I get presented with alts a lot. And in many cases, I'll spend some time in the due diligence looking at them. Deals where you can get into commercial real estate or different hedge fund type deals. Now, in that category, the fee structure is extremely important because after you make back a certain amount, then the guy or gal that puts together the deal gets like 20%. And I'm basically cheap. So I can't abide by that. I can't do it. I am sorry. If someone running the deal is going to get like 20% after a certain point, I don't like that. So those type of deals I stay away from. Some people do, and obviously I guess they make money because they're still around. The type of alts that I do like, I love real estate because as Jade said, real estate has amazing tax benefits. And with real estate, you're always working on leverage. Nobody buys a property outright for cash except, an old person who wants to buy their home for cash. So the leverage works really well, and real estate typically appreciates, not fast, and you also get that appreciating rents. So real estate deals I'm very happy with. I like direct real estate, buying the property. But if you're not going to buy the property, I like REITs, which are very, very they're cheap. You can trade them on the stock market and you can get in and out of them on a daily basis. But to your question, am I invested in alts? Besides having some REITs, I also have a smattering of dollars in a few different crowdfunding opportunities. And I will say, I'm not going to say the names, the ones, a couple of them I've gotten out of with, they're mainly debt type investments where they lend out money and then they give the investors a certain amount of money back, with the interest, less fees, etc. Those have been marginally profitable, nothing like the returns that were promised. And final words are, just as Jade says, do your due diligence and don't put all your money in alternatives.
Yeah, I think that's good sentiments. Mark, so your version of alts is kind of like the traditional version of alts, the
Yeah.
non plain vanilla stuff. But do you ever look at things like private funds, like private equity or venture capital or oil and
No,
gas or
it's no. My background says more in trading. I mean, I was heavily into real estate before we emigrated. When I came up to 40 and we went off to live on a desert island, we bought 10 properties. And as Barb rightly says, you're leveraging, and we were paying a pittance in terms of a deposit, and you created income from day one. The UK now, we've sold them all bar one because the tax breaks have gone. It's a very socialist government who are penalising the landlords. And you've had the issue as well with the BlackRock scenario going in and buying a lot of these properties as well. So for me, it was very beneficial and I was in at a good time. But for me, in my personal circumstances, it's not great. And I'm always a bit scared with REITs because depending on what the REIT is, but if it's anything to do with domestic, obviously if there's a downturn in the economy, or even with commercial, if there's a real downturn, is there not a danger that you can't always pull your money out? Because I've seen that scenario before. No, not a thing.
Yeah, I mean,
I've been
go
investing
ahead.
for 40 years now. REITs haven't been around that long, but I've probably been in REITs for 20 years, and I've never seen that on a publicly traded REIT.
Yeah.
But again, I don't know if you invest in like a really niche REIT. And that's one of the cool things I like about REITs is if you're really bullish on, say, storage or senior living, you can get a REIT just in that sector.
Yes.
But no, to your question, Mark, I've never seen it.
I saw it in London in 2009 with the crash. There was what they did was basically it was a property company. It may not have even been built like a REIT, but it was that idea. But basically, the property company turned around and said, "Look, everything's fallen that quickly. We're not going to allow people to pull the money out because it'll all collapse."
Now,
Um,
was it on the public market though? Was it trading on your stock
I
exchange?
think it was traded on the stock exchange. I mean, I did
Okay.
see one recently that fits your criteria that was a good one for the UK, that it was warehousing and they've got
Oh
97%
yeah.
occupancy and it's Amazon, etc. So that would be interesting. I mean, the thing with you and I, Bob, we're kind of at complete opposites of the investment scale. You're traditional and go in great depth with earnings and everything else. I look at it from a trading perspective, and I think, well, if I'm in the right sector at the right time, I'm in. Um, and then I would I would scale out and take profits along the way. So, I mean, you and I are completely the opposite, but at the end of the day, we're all here to try to make money.
Yeah, no, I think
Exactly.
that's
And that's what's really nice because our listeners can see different perspectives with the same end goal, obviously.
Yes.
And I just have to throw out, Mark, I think you and I are of the same epoch.
Yes.
Kurt's trailing a little bit behind us.
Yeah. Yeah.
learning from the masters, Barb.
But the other thing about this is that if somebody comes to me with $1 million and says, what would I be the best thing to do in terms of investment? You wouldn't have 100% of it in alternative. Obviously, you would go for the traditional stuff, and then depending on their risk tolerance as to whether they're going to put 10, 20% in. So there's still the need for everything. It's just with my particular bias, and because I'm looking at charts and things every day, it's easy for me, and therefore we spoke about we were talking last time about value. And for me, I can find value all the time because, hey, well, there's a dip and it's down 25%, I can buy it. So it fits my rules.
Well, I think, I want to bring up this concept because I think it's interesting in many ways, is that when you're looking at what percentage you put in alts, the common consensus is, well, you have a little bit in alts,
Yeah.
for many reasons. And I look at it differently. I think there's more nuance than that. Um, I've had a lot of conversations with regulators, with clients over the years, and I don't think just anybody should have a high percentage in alts.
Mm.
But if you do real estate for a living, if you're a contractor, if you're a developer and you do real
Yeah.
estate for a living, you should probably have all your money in real estate, not in the stock market, because you
Yes.
don't know the stock market. The stock market is an alt to you, right?
Yes.
And if you're in oil and gas, you should probably have all your money in oil and gas, not in tech stocks that you know nothing about.
Right.
So I think, the nuance I want to kind of point out here is I think, people in general who don't have an expertise in a certain area, um, it makes sense to stay a little bit more plain vanilla because there's liquidity and all these other things going on that people can kind of wrap their head around. But an alt might be something really weird and illiquid and something that's off the beaten path. Um, but if you live off the beaten path, then the traditional stuff is an alt to you. So I just want to bring that up because I don't I agree with what everyone's saying. I don't think everyone should have a lot of money in alts if you're not familiar with them. But if you're familiar with them, an alt might be something that you're not familiar with. And
Yeah.
Mark, you do trading. That's off the beaten path.
Well,
Very few people are good at that.
the difference between you two as well is that you're regulated and you are planning it in a very conservative method. I'm more in terms of doing my own thing and teaching. So I will train people to be able to do it for themselves. And a lot of the times I think that the buzzwords and the terminology and people talk about global macro. I went down that rabbit hole 7, 8 years ago, and it was you would never make a decision if you based it all on global macro. So again, it's you two guys are regulated and coming from that side of the industry. I'm coming from the guy in the street who wants to learn how to do it, and that's how I learned. And so again, we're at different parts of the scenario, and your regulations and strictness is completely different to mine. I can just do things.
Yeah. Yeah. I mean, the point of the podcast here is to educate people on all aspects. And I
Yeah.
think the reason we have this panel is we get different points of view, right?
Yeah.
There's no single point of view that's correct. There's different perspectives and different points of view.
Absolutely.
I'm just bringing up a different one that I see because, anything is an alt to somebody who doesn't do it.
Yes.
And,
Yeah,
but,
good point.
the traditional definition of alts is typically, funds like private equity or hedge funds or oil and gas or something that's illiquid. It's more of a private fund. That's how kind of Wall Street has kind of aggregated the term. But as Barb said, it could be a rental property. That's an
Yeah.
alt, right? I mean,
Yeah.
so I think it's good to open people's minds to the fact that there's different perspectives for different people, and you
Oh,
have
for
to
sure.
figure out what works for you. Because I would agree with you, Mark. Like there's alternative assets, and then there's alternative strategies,
Yes.
right? So you could have Amazon, Facebook, Microsoft, Apple. You could have the the Mag 7 stocks, and that's pretty traditional. But you could do something weird with options or some crazy hedging strategy, and
Yeah.
that would be an alternative strategy, right? And you're getting a different correlation than you would be just owning the stocks. So um, I want to talk about that a little bit. Barb, we don't talk about that as much on the show, but what are your thoughts on that for people that were interested in alts? Maybe a traditional spin or a traditional asset with an alternative spin.
The thing about any investing strategy, it has the possibility of working and of making you money. But the overarching thing, if you're getting in with a guy or a gal who is promoting a certain strategy and the marketing may make it sound really glamorous, and you're like, wow, can't miss 15 to 20%. It sounds great. It's not too high that I don't believe it. There are 2 to 3 things you must do before you jump in with all fours or all two. And that is look at how much the fund promoter, the fund owner has invested in that strategy. 2, look at the fee structure. What are they charging you? Because there is so much research out there that lower fee strategies equal higher returns. And it's common sense because if you're spending a lot of money on the fund provider, less of your money is going into the investment. And number 3, and so many people fail to do this, look at the background of the fund promoter, the fund originator. I cannot tell you how many people, all you have to do is look them up on LinkedIn. And I'm sorry, I am not going to invest in with a 25-year-old guy who, bought a couple real estate properties and is now selling me a big syndicate. I'm like, no way. They better have good credentials and a lot of experience. But marking back to that, Kirk, I have a question for you from the interview. Jade had said that one of the best ways to get alternatives is going through a financial advisor. Could you elaborate on that in terms of what do you think are the benefits of going through an alt with a financial advisor and pros and cons, costs, that sort of thing?
Yeah, I could touch on that, and just for context, I mean, I think ADISA does a great job. We've worked with them for a number of years, and the challenge with alts is in a large part is sourcing and due diligence, right? Because Megan was on the show a lot before, and she does a lot of these, right? Private equity, venture capital. They do tranches and vintages and all this. When you're worth like $100 million, you get into that sort of stuff. Most people, it's not really for them, and so what I find is that sourcing, there's a lot of deals out there, quote unquote deals, right? Put in air quotes. Um, you can find them everywhere. And if you can find them, they're probably not a good idea, right? Because if they're really looking for capital, they might not be a good deal. Because the good deals, they're not out looking for capital. They can get a capital very easily because it's a good deal. Um, and that should be your initial framework, is that if I'm seeing this deal, it's probably not a good deal. So you shouldn't go in with the, oh my God, pie in the sky, this is going to be great. As Barb said, like a lot of the crowdsourcing stuff didn't work out as advertised. A lot of deals don't work out as advertised. That's just kind of how it works. They're trying to promote their stuff. So, the one thing ADISA is good at is sourcing good investment sponsors. So people who kind of pass muster, right? So they're good at that and talking about how to do that, and also due diligence. There's actually a few firms. I think there's two or three firms, like law firms technically, but where they will provide due diligence on an investment. And if they provide it, they will backstop it for fraud and other things like that. No, they're not backstopping performance, right? Performance is whatever happens to the investment, but they're backstopping the due diligence process. So the big challenge for 99.9% of the people is, how do you do proper due diligence? Now, my firm, we've been doing this for a long, long time, and we're pretty good at it. Um, but you still miss stuff. Like, even if you're good at it, you still miss stuff. Like, there's limitations on what we can do. Now, there's a firm, I'll give you an example. So there's a firm that was based out of Boston, and I think they were called F Squared, and they were growing like a weed. This was maybe 2015, 20 years ago. They were growing really, really fast. Fast. People couldn't even believe how fast they were going. And what they were doing was what they were claiming to be doing was they had these methodologies, these trading strategies that were working, and they kept pumping out great returns, and everyone was just like, "Oh, this is really good." Well, and I could be wrong in this, but my understanding of this, I don't want to, slander anybody, but my understanding of it was what they were doing, according to what I read at the SEC, what they were doing was they were taking, as they were back testing results and publishing the back testing results. And that's what people thought the returns were. But every month or so, they would back test results and pick the best ones and put them out there. Well, apparently you can do that. You just have to disclose that they're back tested results and not real results. And they could have gotten away with it, except for they needed to put one line. These are back tested results. But they didn't have that one line, so they basically closed down the firm because it was. But here's the thing. As a advisor, now we didn't go with them, but I know a lot of the people there, and no one apparently knew, because a lot of my friends were there, like, we had no idea what was going on. So, here's the thing. How would I have ever known that? I wouldn't have, right? There's no way for me to know that. They basically put out results, and then the actual clients were getting different results than what they were publishing. And the clients were like, what's going on here? Why are these results different? And then, the SEC got involved. I believe it was the SEC. They got involved, and it all kind of came down. But they didn't steal people's money. Like, it wasn't like a Ponzi like Bernie Madoff. They were just publishing different results for marketing, and people were not getting the results they wanted. And so people got upset. Point being is if they just put that one line in, they would have been covered. But because they missed that one line, that everything came coming down. Now, apparently, to my understanding, a lot of advisors who were using those funds, um, the regulators went after them. Now, I try to put myself in the shoes of the advisors. What would happen to me? And they got fined and all this stuff. But as an advisor, if I did due diligence, there's no way for me to figure that out because I'm going on what they give me. The only way I could have figured that out is if I actually had a client there and then saw the difference. That is the only way I could have figured it out. Otherwise, I would have had to have an audit done. I would have had to go check their bank records. I mean, all this stuff and when you're doing due diligence, you want this stuff to happen. But they're not going to do that for me because I'm just one small fish in a pond. If I said I got $1 billion, they might do it for me. But for, just Joe's six pack, they're not going to go open their books and do an audit and spend all this money. It's just not going to happen. So these firms, these due diligence firms, what they do is they will tell the fund, they'll say, all right, it's going to cost you, let's say 50,000. I don't know what the number is, but it's not cheap. We're going to charge you 50,000. We're going to do due diligence. You're going to pay this. We're going to give you a result. You may not like it. You may hate the result that comes back with, but we're going to give you the result in an unbiased way. And they come out with a result. And then if you want a due diligence report, you have it. And this firm will back that result. They'll say, we stand behind this. We did the due diligence. We stand behind the result. So if there's fraud or anything else, they'll say, all right, we're on the hook because we did this. Now, as an individual, you can't do that because no one will do that for you. They're not going to spend that kind of money. They're not going to go spend 50 grand or 100 grand or whatever it costs to go do the due diligence. You've got to do it yourself. It is a huge amount of work. And unless you're able to get in the weeds and look at bank records and all and doing background checks and all this stuff that most firms are just not going to do, you're putting yourself at risk to some degree. This is one of the biggest problems with alternatives is the lack of transparency and illiquidity is a risk because you don't have liquidity, but once you get in, you can't get out. So you're taking a risk, and that is one of the biggest challenges of alts. We're in the space a lot, and we do a tremendous amount of due diligence, and there's a lot of stuff we won't do because we're just not willing to take the risk as fiduciaries. We can't afford to take that risk to things that we can't quantify. You're not able to get in there and actually get in the weeds. So this is why I like ADISA because they're really trying to put together a fair playing field, and the people that are involved, there's a standard they're trying to promote, and I really like what they're doing over there. And I think the challenge is when you're in the 10 million, $100 million space where you have a lot of money coming at you, the players tend to be willing to say, okay, yeah, sure, you can come and look at our books or whatever. You're going to give us $1 billion. We'll do whatever you want. So, I don't have that ability. Barb doesn't have the ability. Mark doesn't have the ability. That's the problem with individual investors. And I think that's the risk for most people. So I forget your original question, Barb, but I can tell you that the way that we look at alts is with significant skepticism, but we still do them. But you have to be overly skeptical about everything because you have limits on, even if you wanted to, there's limits on what you can actually get accomplished.
But the thing that strikes me from the story, and let's say for legal reasons, let's think of a scenario like that. It just sounds to me as fraudulent. I would expect that in the retail space because the retail space is full. Barb talks about going on LinkedIn. Well, please don't go on YouTube because the level of nonsense and skullduggery that goes on there. But even in a simplistic level, for somebody off YouTube claiming for the results to use a back test, I would have thought that was fraud. I mean, you're saying quite rightly, Kurt, well, we couldn't investigate. But surely if they're regulated, how the heck can they make a claim based on fraudulent data information? I don't understand how the heck.
Well, let me clarify. So my understanding, and this is secondhand, so this is why I want to put huge disclaimers around this story because I'm only knowing what I read,
Mm.
in public. But the the understanding that I had was you're allowed to put out back tests.
Yes.
So I know this. You're allowed to put out back tests. You're allowed to publish stuff.
Yes.
What the rules are really clear about is disclosure. It's not
Absolutely.
that you can and can't do things. As long as it's disclosed,
Yeah.
you can do almost anything you want.
Yeah.
So the issue that they were having was they were putting out back tests as if it was the results.
Yeah. Yeah. I
And
get that.
they probably was a whole page of disclosures, right? But if there
Yeah.
was one sentence in there that said these are results of back tests and everything else was the same, that would have been okay, is my
Right.
understanding of the situation. And people who want can go back and research this themselves. If I'm wrong, like I said, apologies. It's more of just this happened years ago, so I'm going on memory. But
Mm.
the reality is that was a great case study of
Yeah.
the rules and regulations that because I remember we looked at them, we really liked what they were doing. I'm like, I really like this. I just never pulled the trigger. I was like, it's just gonna be a pain in the butt. And I was like, we're not doing it. But we liked what they were doing. What they were doing looked great. All the
Mm.
numbers looked great, and I knew people there, so I knew it wasn't like it wasn't a Bernie Madoff situation. Like these people worked
Oh.
there. They were in the numbers. They knew what was going on. But how they got the numbers, apparently it was just they were fabricated or back tested, and um, people. I mean, how many people are involved in that loop? I mean,
Yeah.
honestly, like if you're looking at that loop, that if you have a whole well-run company, right? They had billions of dollars under management. It was well-run all the way around, except for one thing. You had a portfolio and you had performance, and they weren't lining up.
Yeah.
Well, where is that loop? That could be one person. It literally could be
Mm.
one person who does performance reporting. That one person, if that one person was the one in the loop and no one else was, no one else knew, right? And this is how weird the whole situation was, is because it was technically fraud. They were defrauding people, but if they had just put that sentence, it wouldn't have been
Yeah.
fraud. And you had one person in the whole company who knew what was going on. No one else knew. Like it was the weirdest thing. But my whole point of this is that this really simple thing that took down the whole company um, was something you couldn't have figured out on your own. Even if you were looking for it, you couldn't have figured it out. Show me
It
the
happened.
statements. Okay. They're going to show you statements of clients? No, they're not going to do that and compare those to performance. Like, if you really think about what would have to be done to discover this, it was close to, a non-zero number, but close to 0% chance you could ever discover this
And
unless you were given full access to everything, which of course they're not going to do, unless you're contributing a lot large money. And if you were and you were trying to do that, they would probably know and say, all right, no. So,
yeah.
you know, I, that's part of the problem, right? Is that this stuff can be so deviously small. I mean, most people worry about like Ponzi's, right? Like fraud,
Yes.
fraud from the standpoint that they're stealing, not misrepresenting. And I'm not saying misrepresenting is not fraud, but I don't know technically what the rule is if it is technically fraud, but it's illegal, right? So let's put it like that. Let's just call it illegal because I don't know what the technical term it would cover. But if you look at it, like there's a difference between theft because I've seen theft, right? I've seen borderline Ponzi's, not quite Ponzi's, but fraud in the sense that they were stealing and clearly trying to steal. This is more deceiving, right? Which
Mm.
is still not good, but it's different, right? So there was a situation we saw many years ago where we knew about it. We actually told the regulators and nobody did anything. And eventually people lost a lot of money. And then they came back and said, oh, I heard you had some stuff. And it's like, well, it's too late. People lost money. But
Mm.
we knew about this. We told people, and just no one did anything. So sometimes it's obvious. People lost money on that thing. It was in the papers. It was all over the papers. Like as soon as it came out, we saw it and we're like, oh, well, we knew it. But that stuff's different. That stuff's easier to discover when there's theft. But when you're deceiving people, it's a lot harder to spot because it could be something so small as a single person is
Yeah.
on the loop and no one else is. It,
It happens all the time though in retail, away from the regulated. And there's a well-known promoter in the UK who allegedly was a good trader, and so you take it to the nth degree. He could be running 50 back tests at the same time, and then would pick the best one, and they would use that for an automated strategy. And then the other thing with strategies, I have a strategy that basically I've used the same thing for 20 odd years, but I do tweak it from time to time because ultimately the strategy that worked in a non-Trump era is different to a strategy that in a calmer environment. And years ago, we all used to have a London breakout strategy, which worked really well for years because the Asian session was quiet and then London kicked in and then New York. And it was easy to make money, but it stopped working because the pattern changed because Asia got busier and the daily range changed. But yeah, the thing with what you've just described to me as a non-insider in terms of hedge fund, I just thought it sounded like fraud. And this does go on all the time in retail, and this is what you get on YouTube all the time. And this particular guy used to do presentations in big hotels, and he'd come out with a laptop on for the trade of the day that he'd got on, but there'll be another half dozen laptops around the back, all running different strategies. So whereas that one may be fairly unique, further down the food chain, it goes on all the time. And if you allow it at your level, then you can understand why at the lower level they're doing what they're getting away with what they're getting away with. But it's fraud. I mean, it's misrepresenting what you're doing, isn't it?
well, and I appreciate what you're saying. To put a finer point on it, because I don't think I was clear enough. I think the whole thing's fraud. My point is it would be allowed,
Yes.
technically allowed,
Yeah.
if you put that sentence in there,
Yeah.
which I think is still fraud. But apparently, according to the rules, the way it's set, as long as you disclose it, it's fine. And I just look at it and say it's misrepresentation. It's not, it doesn't matter what you disclose. If you're misrepresenting it, even if you're saying in one sentence that, oh, this is back tested, well, it should be on the title. You shouldn't be able
Well,
to
I was
allow to
just going to
publish
say
this.
it should be in big letters above the
Yeah,
font. I was just thinking, I have an insurance policy I've just signed out here on a new car. It's in Portuguese, which I struggle with, and there's 28 pages of it, and I have to sign that I've read it. And like anything else that you see on the internet, sign to, oh, I've just signed the damn thing. I have no idea what I've just signed.
right,
But that's the way of the world, isn't it?
right.
So yeah, if it was in big letters, like, you've got behind you the United States of America, that's great. But if it's buried on page 27, even if it's in there and it's in tiny text and buried, no, it's misrepresentation all day
Yeah.
long.
No,
What do
I
you
agree
think,
with you.
Bob? What do
Yeah.
you think, Bob?
I'm going back to the Schwab Intelligent Portfolios robo-advisor. And for those of you who don't know, it's an algorithm-based investment. And like many others, Wealthfront, Betterment, whatever. But Schwab's strategy requires you to hold about 10% cash. It's very clear that if you get into this strategy, you're going to hold 10% cash. And it's understood, of course, that when markets go up, that's going to be a drag on your performance. When markets go down, it'll probably cushion your losses a little bit. Well, I actually invested in this for one of my retirement accounts. I knew about the cash. I'm fine with it. They got fined, millions and millions of dollars because investors claimed that they didn't understand that there was cash that had to be held in that portfolio. And they paid these fines, and now they have in big letters, we required you to hold a certain amount of cash,
Yeah.
and it may be a drag on returns when markets go up. Well, my point is, I knew that. Look, I know a lot about finance, so I knew it. I read all the documents. I am 100% sure that was listed in the fine print in the documents because how could it not be? I don't remember exactly. So my point is that even if you disclose something, if you don't disclose it well enough,
Yes.
then you are at the risk of getting in trouble for it. But in accord with what we've all been saying is you have to do your due diligence. And even if you don't, even if you do your due diligence, it doesn't mean you're going to catch everything.
Yeah.
And so that is where the fallback is. Don't put all your money in any one deal or strategy.
The other thing is, I used to be in the food industry. In the food industry, there are rules and regulations in Europe, for example. If something weighs more than a kilo, the typeface and the font has to be a bigger size. And it's that control. So the regulation is within a document, it's got to be this size of typeface, this size, this header, etc., etc. So clearly, without us all going into the weeds of this and boring ourselves silly, somebody needs to sort it out whereby things are laid out very clearly. Because as you rightly said at the beginning, Kirk, the man in the street really, if he's a plumber, with the greatest respect, unless he studies this to any detail, he doesn't really know what he's doing. And that sounds more disrespectful than I meant, but it has to be clearly said, you could lose all your money and et cetera, et cetera, et cetera. So anything less than that is not clear and is unfair, I think.
I don't
Well, and
know.
I like what you said.
To be frank, I mean, it's not disrespectful to plumbers because I'm not going to pretend like I know how to, plumb.
Yeah,
You know what I mean? Like,
absolutely.
so I think the biggest challenge is most people are not knowledgeable about investing. The people who listen to the show obviously want to learn, want to get smarter. Investing's hard. I do this, for a living, and I'm still learning stuff every day. Right? We all are.
Yeah, for sure.
It's a never-ending battle. You can never learn everything. And as you said, Mark, the situation changed. You got to change your strategy. Like we're always adapting to stuff. It's very hard. And frankly, I'll bet Schwab had a pie chart, and I'm sure it said 10% cash. I'm sure it was very obvious, but it's like the woman who spilled coffee on herself, and now McDonald's has to say, "Be careful, it's hot." It's just the moron
Exactly.
tax.
And McDonald's again got fined a tremendous amount because a woman spilled hot coffee on herself.
Yeah, she had it in her lap while she's driving. We're all paying for the moron tax, right? There are people out there. There's actually a good book. I'm trying to see if I can find it. But it's basically, I'll look for it while you guys are talking. But it basically talks about the fact that there are stupid people out there, and the stupid people are the ones that make everyone else's lives challenging. Because if you really can't figure this stuff out, like the situation I mentioned with that firm, like that's deception. Clearly, whether they had the sentence in there or not, it's deception. But you're talking about like some of these situations, like the coffee's hot, or the Schwab thing. I mean, give me a break. Like I think stuff like that. We have too many attorneys when we have stuff like that. Like of all the stuff going on in the world, like child trafficking and war and all the bad stuff, and people worry about, well, you didn't disclose it enough. You had the wrong font. Like F you, buddy. Like this. Go away.
I nearly got taken to court over it because we were producing pizzas and we were in one area, we were in, let's say, one state, had one set of rules, and then we started exporting to another state, and we nearly ended up in court because state B interpreted the rule different to state A, and I just had a million labels printed. And if you want to go down the insanity route, go to Europe. Because they're not very good at anything else these days other than regulating things to the nth degree. So
I'm gonna share this book. It's called The Basic Laws of Human Stupidity. It's a legitimate book. It's actually really, really good. And it's somewhat of a joke, but if you read it, you're like, this is actually really true. And I highly recommend you read it if you enjoy dry humor like me. I think it was Nassim Taleb actually wrote the foreword for it, but it's quite good. I'd read it if you're if you appreciate the nuance of human stupidity like I do. Then it's a great read.
And let me throw out, Nassim Taleb is the author of The Black Swan, so he is. I mean, that's an amazing book as well.
Yeah. He's written some great stuff. Highly recommend it. Well, in the interest of time, we're going to wrap it up here. Final thoughts from you, Barb.
Well, this was super fun, and I was thinking of how I'd feel if I had listened to this podcast as just a listener, and I'd be like, this stuff is so freaking confusing and scary. I'm running for the hills. And, if you came away with that kind of feeling, you know, you're partially right, but it just underscores that you have to do your homework. You do the best you can. You're never going to know 100% of anything, of any investment, of anything. And therefore, don't put all your money in the next greatest
No.
investment that comes your way. Just a small amount, a small taste that you can afford to lose. I'm Barbara Friedberg. You can find me on YouTube. Mark, I am one of the ones who gives sensible investment guidance. So please don't lump me in with these pie in the sky ideas. And you can also find me on Barbara Friedberg Personal Finance.
Thanks for coming on, Barb. Mark, final thoughts from you, and where can people find more about you?
You can find more. I'm on YouTube as well, and X, Mark with a C. And our main education website is forexmentorpro.com. I think, again, it's balance, isn't it? It depends. For somebody, Barb was talking earlier about a certain type of age group of person. The young people now want to get rich quick, and they got spoiled. They got spoiled with crypto because whilst I got involved in crypto in 2020, I spoke to one of my clients, and his son had just started university. And I said, ask him how many at university are in crypto. And he came back and said, all of them. The entire university is in crypto on the phones every day. And they were all making money, and it was like falling off a log, and they got spoiled. And so again, it's balance. And as we know, if you're 20 and you're willing to go for it, then have a go, because you've got plenty of time to catch up later. Obviously, if you're near mine and Barb's end of the scale, then you need to be a damn sight more careful.
Nice. And where can people find more about you, Mark?
I say Forex Mentor Pro, or all the educational stuff. You can find a lot of it on YouTube.
Awesome. Well, thanks for coming on, Mark.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.